Hey guys, welcome to Individual Investor. This is the last video on the introduction to financial statements. Today we're going to talk about the statement of cash flows in more detail, and we'll learn how to apply the concepts using Coca-Cola's 10K form. Enjoy. The statement of cash flows aggregates all the inflows and outflows of cash for a particular period of time. You should use it in conjunction with the income statement to understand if a business is performing in a healthy way. A company could be turning a profit from the sale of products and services and still have negative cash flow, and vice versa. A company can show positive cash flow, maybe because they had to liquidate or sell a lot of assets, so this shows as an inflow of cash into the business, but at the same time it could still have a negative income. Remember also that the income statement is driven by something called accrual accounting, which means that revenues are recognized or recorded when the transaction is made and not necessarily when the money is physically received from the goods or services sold. The same applies to expenses as well. Obviously, there are accounting standards and principles to prevent companies from inflating their income by fabricating the sale of products and services on paper. However, even with existing accounting rules, some companies have managed to cook the books by using things like mark-to-market accounting. The most famous scandal was Enron, where they managed to write unrealized future gains from trading contracts into their current income statement, which massively inflated their profits. But if you were to actually look at the statement of cash flows over time from Enron, you would have seen that these gains were not real because there wasn't any inflow of cash coming into the business as a result of these unrealized gains. There's actually a pretty nice and interesting film documentary on this called Enron, the Smartest Guys in the Room. If you haven't watched it, I highly recommend it. Okay, let's review now the three major elements in the statement of cash flows. These are the cash flow from operations, or CFO, the cash flow from investing activities, or CFI, and the cash flow from financing activities, or CFF. The cash flow from operations, CFO, aggregates all the cash flows from core business activities. For example, here we can find things like inflows from the sale of products and services, but outflows to pay for the distribution of such products. We can also find things like employee salaries, which would be considered an outflow. If there's any prepaid revenue, this will be considered an inflow. But if we have any prepaid expenses, on the other hand, this will be considered an outflow of cash. As an investor, you typically want to see positive cash flow from operations because this indicates that the company can finance growth without having to raise more debt. But if, for example, you're investing in an early stage tech company with negative cash flow, what you want to see is a path for the company to get to positive cash flow over time. Cash flow from investing, CFI, has to do with investing in the business. Most of the times, what this means is buying or investing in things like property, plant, and equipment to either expand or optimize costs, or maybe acquiring other businesses. For example, if you were to buy a new asset, let's say a new factory to expand production, then this will be considered a capital expenditure, which is an outflow of cash. But on the other hand, if you were to sell an asset, then this would show as an inflow of cash under CFI. And finally, we have the cash flow from financing activities, or CFF. The CFF aggregates all the cash flows from business financing. This is summarized in basically the equity and debt financing. If the company has to raise capital, they can accomplish this by either selling stock or issuing bonds, which are reflected as inflows of cash. On the other hand, examples of outflows would be the interest paid to bondholders or dividends paid to shareholders. Alright guys, if you're enjoying this video so far, I would really appreciate if you can please give me a thumbs up and subscribe to my channel. Thank you very much. And now it's time to take a look at Coca-Cola's 10K form and apply the concepts that we've just learned about the statement of cash flows. Okay, perfect. So we have now here the 10K form from Coca-Cola for the year or for the fiscal year that ended this past December. So this is the latest 10K form. So if we go now to the statement of cash flows, we have to go to the financial statements and then statement of cash flows here. Perfect. So the first thing to note here is that we have the three main sections that we discussed, right? The first one is the CFO, or cash flow from operations. The second one is the cash flow from investing activities, or CFI. And then lastly here we have the cash flow from financing activities, or CFF. All right, so it's pretty straightforward. Now the first thing to note here, if we look at the CFO, is that we start off with the consolidated net income right here. So this figure is actually the net income right from the income statement. Okay, so this $9.8 billion actually comes from the net income. And without getting too much into the details here, what most companies do, the way they calculate the CFO, is by doing something called the indirect method. Okay, and there's two methods: the direct and the indirect. Most companies again use the indirect method because it's simpler, especially if you're a big organization. What they do is basically they start off with the net income, and then you start to add or subtract basically cash flows from the net income to arrive at your final figure over here at the bottom. Okay, so again, we start off with the bottom line net income here, and if we look at the past years, we can see that Coca-Cola actually decreased a bit in terms of net income. It got smaller in 2020, and then in 2021 actually it rebounded. Okay, so again, Coca-Cola being Coca-Cola, we know that this is a huge cash machine, and so yeah, you can expect pretty much a steady net income over time. So again, we start with the net income, and then the first thing that you will see here is that we're adding depreciation and amortization. Okay, now depreciation and amortization is a figure that is actually is a non-cash element, and a lot of these are non-cash elements that we're going to add or subtract from the net income. Since assets that Coca-Cola has will depreciate over time, in the net income or in the statement or in the income statement, you will see that depreciation and amortization is actually shown as a negative, right? Assets depreciate over time, but what we do here is that we add it back to the net income, because again, remember that we're looking at cash flows here, and in reality, for depreciation and amortization, there is no real outflow. Okay, so cash is not leaving the business, so we add this figure back to the net income. Okay, we also have here other non-cash items like stock-based compensation. Again, this is stock, right? That again is this is not cash leaving the business, right? This is not an outflow, so we add it back. We have also income taxes, deferred income taxes, that we're gonna add back to the net income because we haven't paid them yet, right? Then you have here this one is an interesting one, equity income loss, net of dividends. This has to do with actually ownership of other companies or subsidiaries, right? So Coca-Cola, they have investments in other companies, and which obviously when those companies produce an income, that income is considered part of the Coca-Cola's income. But if those companies, they if those companies pay dividends to their shareholders, right? These dividends, this is real money going out of the business, out of these companies that Coca-Cola owns. So that's why we have to subtract these dividends from those companies from the net income. Okay, so we subtract that. There's some currency adjustments here that get added, some gains or losses as well. Again, this is real cash leaving the business, right? Other operating charges, other items. I'm not too sure what these are. And then here we have the net change in operating assets and liabilities. So we add this back to the net income. Here we have changes in things like accounts payable, accounts receivable, cash, etc. So at the end we're adding here this figure. So if you add this up, right, the 1.4 billion, 337, 894 minus 615, etc., then you get you get this figure here, which is the CFO, the cash flow from operating activities. And like I said before, the CFO is super important. You want to see cash flow from operations actually, depending on the type of company, you want to see it, positive or increasing, because this figure right here, this cash flow from operations, is what the company, or in this case Coca-Cola, will use to pay things like debt, interest, or use for capital expenditures to invest in the business, etc. So this is the cash flow that probably matters the most when you're analyzing a cash flow statement. Okay, perfect. So we have that's the CFO. If we now look at the CFI, okay, this is pretty straightforward. So the CFI is mostly outflows, okay, because again, this is money that goes out of that leaves the business, that goes out of Coca-Cola for investing purposes. So these are, this is an outflow of $6 billion for purchases of investments, maybe minor, company acquisitions, or maybe, they're buying smaller businesses. This is a positive cash flow here from, proceeds from disposal of investments. So maybe they're selling smaller businesses that they own, things like that. So there's money coming in. Here they are acquiring businesses, okay, or or non-marketable securities. So that's again money that leaves the business. So that's a real outflow of cash. Likewise, disposal of businesses or other non-marketable securities, an inflow, or some that's some money coming in. Here we have some PPE purchases, so property, plant, and equipment. Obviously, that's an outflow, right? They're buying equipment, and then at the same time, they're also selling equipment, right? Here, so that's an inflow of cash, and there's some other investing activities here. So at the end of the day, you're left with a negative figure here, $2.7 billion, which is pretty normal, right? Because typically when you're investing in the business, you are spending money to expand or to optimize your operations, right? All right, and finally here we have the CFF, or cash flows from financing activities. This is pretty straightforward as well. The first line is the issuance of debt. So obviously here you can see that Coca-Cola raised some capital using debt instruments like bonds or maybe credit notes. So yeah, that's $13 billion worth of debt or capital raised through debt instruments. They also paid, the second line here, they paid off some of the debt. So that's obviously an outflow of cash. Okay, this could be things like the interest paid paid to bond holders, or maybe the principal payment back to the bond holders. They also issued some stock. Okay, so that's $700 million worth of stock that they sold. So that's a positive. Here they also bought some stock for treasury. So these are things like share or shares buybacks or stock buybacks. Okay, when Coca-Cola buys back some of their own stock. Okay, so they spent $111 million buying stock back for the treasury. And finally, here we have the dividends. Okay, so as we know, Coca-Cola, they pay a dividend to their shareholders, and they paid, roughly $7.2 billion worth of dividends. So this is one of the reasons Warren Buffett invested in Coca-Cola back in the day. He makes so much money off of Coca-Cola on a yearly basis just on the dividends. So that's pretty cool. And then finally here we have the other financing activities. I'm not pretty sure what these are, but it's not that big of a number. All right. So if we add everything up, then we arrive at this figure. So $6.7 billion that went out. So this is an outflow of cash for the investing activities. All right, guys, that's all I have for now. This video concludes the Introduction to Financial Statements series. I really hope that you enjoyed these videos, and more importantly, that you learned quite a few new things. If you have any questions, comments, or any topic suggestions, please leave them in the comments section below. Thank you again for joining me, and I'll see you in my next video. Take care.